Coming up, ANZ's new Portuguese CEO. Another warning from Woolies about strike action, and the Australian dollar falling to below 64 US cents. We'll tell you why and what happens now, next. Hi everyone, it is your daily 10-minute business and finance news wrap for this Monday, the 9th of December 2024. The Australian share market was pretty flat today. The S&P ASX 200 up just 0.02% to 8,423. There was a bit of corporate news out today. The major one, the ANZ board looking offshore for its next CEO, who will start mid-next year, tapping 57-year-old Portuguese banker Nuno Matos for the top job. Now, he was previously the head of HSBC's wealth and personal banking business, responsible for 87,000 employees, serving around 40 million customers. And he replaces Shayne Elliott, who leaves after orchestrating a near $5 billion takeover of Suncorp's banking business. What does it mean for the banks, especially at a time when there are a number of new faces leading various banks around Australia? For that and the market moves today, I spoke with David Berton-Jones, a Joint Chief Investment Officer at Aequitas Investment Partners.
The first is that equity markets are up enormously over the past month, but are now perhaps taking a bit of a breather, and that's all very normal. The second possible reason is that resources are a pretty big chunk of the Aussie benchmark, and the US dollar has been on a tear, and that tends to be a bit of a wrecking ball for commodities. It tends to be an environment in which commodities underperform, and that's weighed on metals and mining stocks and on energy stocks as well.
I want to talk about the dollar in a moment, but first, the RBA board is meeting today for its two-day board meeting, the last time this year. No change is widely expected, but it does follow some very soft GDP numbers from last week and some expectations of the timing for a rate cut shifting. But what's the market expecting?
No cuts until next year is the short answer. So those GDP numbers are giving us really the wrong message on rates. Retail sales, credit growth, employment, those have all been really quite strong of late. A lot of it is spillover effects from government expenditure, and that almost by definition is producing the weaker private sector outcomes you see in the GDP data by essentially crowding it out. So the RBA is noting that inflation is proving a bit stickier as a result, and in my view is simply going to keep rates high or higher than they otherwise would be as long as the government keeps spending.
Okay. You mentioned briefly before the strength of the US dollar, right? So in turn, the Australian dollar's fallen to below 64 US today. What exactly is behind this?
The US is driving economic policy uncertainty higher. When that EPU, by way of acronym, goes up, the US dollar tends to go up as well, even if the US is the source of that uncertainty. So all of those tariffs being proposed in the US, they simply weaken the currencies of those countries being targeted. So it's an immediate market offset. China and the emerging markets have been ground zero for a lot of this, and they are some of our largest trading partners. So it's not a surprise that that's weighing on the dollar.
I think one of the corporate stories of the day is this new CEO for ANZ. So ANZ, Shayne Elliott, is stepping down to be replaced by an international banker, Nuno Matos. He's got a Portuguese background. What do you make of the appointment, given he's got no local banking experience?
I'm a fund manager. I've been disappointed by C-suite turnovers for nearly 20 years. So in general, I approach any change in leadership with a degree of fairly healthy skepticism. That said, it's quite normal to have leadership with skill sets that are transferable from other industries, let alone similar ones abroad. So given the fairly commoditized nature of the product, mortgages, and the highly regulated market, but also the highly capitalized nature of the banks, I don't see a lot of risk here. He will have his hands full with integrating Suncorp, and it's a way to get some fresh blood that isn't potentially marred by the optics around the trading unit.
What's interesting, though, is three of the big four banks have now announced leadership changes over the past year. So do you think this is just natural progression, or is there something in the water here? Also, what do you think their biggest challenges will now be?
I would not want to be a bank executive for the next few years, that's for sure. So, firstly, in our view, the bank share prices are pretty extreme. The odds of disappointment are, we think, quite high. And if that happens, shareholders will naturally look to blame management. Secondly, arrears, which are bad and doubtful debts, they're quite low and they do have plenty of room to normalise, which means to move higher. And that would create earnings pressure and in turn, we think, would create a bit of a headwind for dividend growth. Then there's the political optics around bank profitability at a time when affordability is pretty much all would-be homeowners can think about. So I think that those challenges would be on the minds of both old and new management.
Another story today, unions have ended a 17-day strike with Woolworths at the weekend, but there are financial implications for the supermarket operator, $140 million worth. To what extent is this a big blow for the company?
Well, the amount of money is quite small, but the general consensus of the market is that Woolworths margins have been too high and that they will mean revert, that they'll come down over a period of time due to improved terms. Now, those improved terms are from the perspective of suppliers and from employees and the like. And I think that that's much more consequential than the quantum of dollars described here.
And finally, as we head into Christmas, we all talk about this Santa rally. Are there any opportunities for investors at the moment?
Well, outside the banks is our first answer. We think that the CBA price to earnings multiple expanding from about 16 times to 24 times is a bridge too far for our appetites. We think that about US equities also, where enthusiasm for the Trump administration has arguably run far too hard in far too short a period of time. Ex-US equities, places like the UK, Europe, Japan, they all look much more favourable in our view. On the defensives front, the yields on offer in cash, government bonds, high-grade floating rate credit, that's also very appealing. By investment style, we continue to prefer value equities to growth equities. For growth equities, you can think of the Magnificent Seven, for example, where enthusiasm for AI has simply run far too far in our view.
That's David Berton-Jones there from Aequitas Investment Partners. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making